we're buying a stock because we want stock to go up, and because the company's got a good business. I don't like the idea of buying a stock because you think the next guy's going to buy it. And I'm actually curious what Al or AI thinks about this, because in a lot of ways, like every time I talk to like sophisticated hedge funds, you'll hear guys who are like, oh, I think that the street will like this, and I think that this will happen. And I'm like, bro, first of all, who cares? Second of all, like, you're guessing as to what some psychological impact is. Like, maybe we just focus on the thing that matters, which is the revenue and earnings over the long run.
Yeah, I mean, I think there's a lot of overcomplicating of it. I think when people sit in front of a Bloomberg for too long, they start to just like lose the idea of what investing is. You're just looking at companies, you're valuing companies, you're looking at management, future potential, you're discounting that. How's the multiple going to evolve? That's the only stuff that really matters. And the street is always wrong, right? What's the average analyst return? And it's just like, it's all just noise, right? If you don't have like, every great investor that has any track has at least a 12, 24-month view, and they're making their trades based on that, right?
Yeah, I think so too. And I think the other big thing is management. Ultimately, like, it took me a really long time to appreciate this, but as a rookie investor, I thought I could model my way out of anything. And over time, I realized that, like, basically the biggest input to any model is like, can management take the balance sheet and which is like their resources, basically. Can they take the balance sheet and do something with it? And, are these people smart enough, clever enough, hungry enough, whatever it is, to actually go take the resources of the company and make something happen? And the current business, you can try to value and say, okay, it's worth this much, and maybe the company is worth that much. But the reality is, the company is actually very similar to biochemistry. It's not like a protein. It's not a static thing. It is something that is changing over time as management applies its resources. And a bad management will take a good company and stop. But good management can kind of turn any situation into a positive if it's really clever and really crafty. They're just people you wouldn't bet against. Even if they have to totally transform a business, so somebody like Elon or Palantir or Anduril or whatever, you can't really look at the income statement as hard as you look at the balance sheet. Buffett actually said this recently. He said that he spends more time in the balance sheet than income statement. I thought that was really interesting and really insightful, because nobody does that on Wall Street. Right? Everyone on Wall Street looks at the income statement first. It's all they spend time on. The balance sheet's kind of an afterthought. But in reality, those are the assets of the company. And the PP&E is the most important line in the balance sheet, where it's like, what is the capital? What are the things here that are creating the earnings? Obviously, so often in today's economy, it's more it's like intellectual property, where it's like, okay, software code, which is not really an asset.
Yeah, I think that whole system is breaking. I agree with you, but I think even the balance sheet analysis is breaking, and I think the reason why is because we're viewing the value chain moving from the capital-heavy model of the past to this like super capital light environment, right? Where like everything changes so quickly.
Well, maybe the point of that is that I don't want to play that game, and that's what Buffett, who's brilliant, right? I think a lot of people were like, have this view of him as like, oh, he's just this guy that, doesn't know technology. Absolutely not, right? Him and Munger could look at anything, but
well, no, he called Apple perfectly, but interestingly, Apple like basically had no balance sheet relative to the value it created, which is really interesting.
That is interesting.
And that's my example, right? It's like these like really like asset light businesses, businesses that are leading.
The whole economy is that now, right? I mean, every drug company, every single drug company, and every single largely tech company, but I'd say I'd cabinet to maybe just software. And what do? And the answer is you don't have to play that game. Go because
they intentionally have no balance sheet. What do? They take all their cash, they buy back shares. Right?
Well, let me give you an interesting example. So there's a really great company called Cursor. Their product is called Cursor. The company name is actually different, and their revenue is gone.
Cursor, we use it.
Yeah, so the revenue's gone from 0 to $1 billion, like overnight. And you're sitting there saying, okay, well, what is the asset of the company? The asset of the company is like 50, Chinese kids. And
it's just a tool. It's a tool that's just incredibly useful, and the value, like, you just can't, it breaks your model.
But right? It's a huge revenue generator with no PP&E whatsoever. And, you know, how do you think about that as a business? And Buffett, if you were here, he'd probably say, I can't get my head around this, because if they went from 0 to a billion instantly, maybe it goes from a billion back to 0 instantly. And I can't pay 30 billion for this, which is the current valuation of the company. It could very well be a $10 billion revenue thing at some point soon.
Well, and the real risk is that, like, does a big tech company build a better tool?
Sure.
Right. And that's kind of the,
I mean,
risk adjusted, you have discount for that.
Yeah, if 20 kids could build it in literally a year, it was unprecedented. Everyone in Silicon Valley is goo goo gagaing over it. But would Buffett buy it? And the answer is no, because, you know, there's no, you know, he'd rather buy the railroad, because it's like, I know there'll never be another Burlington Northern. I just know nobody's laying.
If it's cheap enough, that's always the better bet.
Yeah. There's never going to be anybody laying 6,000 miles of track on our great country that took, you know, decades to do. It's never going to happen again. So at the end of the day, who, you know, why should I ever, you know, try to gamble on something like Cursor, where
when you get them in the pre-seed, and you get them at a $5 million valuation, and you ride that thing, that's when you do it. You don't do it at 30 billion. You don't do it at 10 billion.
Yeah, and of course,
never where the money's made.
You know, my pre-seed book is, you know, 0 after 0 after 0 after 0. So. But
when it's not, though, the one time it's not, that's it.
It'll pay for some of them. You just hope it pays for more than the amount you bought. But what's up, FJ?
You know, there's so much hype right now. I don't understand your point, you know, to short it right now. It would be so dangerous. And I see you quantum shorts, and you always say you make still profit, though they are up by 300, 400%. I don't understand how you can, even though you say you hedge, I don't know what you hedge will be with BYND, right? But this thing, I don't know. It would be a very dangerous short right now to take.
Can I ask you how old you are?
25.
I see. Okay. In my culture, we learn how to speak to our elders. So someone like you wouldn't even be allowed to speak to me most of the time.
Okay.
Yeah. So like you would be at the child's table.
Okay.
You can speak to the children. You know, the adults are here. You know, you wouldn't really normally be able to talk to me.
Give him 6 more months.
I see you bully, man. Okay. Just because you can't explain your profits.
Well, let me ask you, FJ, are you a professional investor?
I made some good money, man.
That is not what I asked you. Do you work for a...
Bro, if Fartcoin went to 5 billion, I don't see why Beyond can't 10x from now.
Do you work at a financial institution?
No, sir.
Okay, that's fine. So you don't work at a financial institution. You're 25 years old, but you think you know how to invest?
No.
Okay. So maybe you should be on listener instead of speaker.
All right, it's confirmation bias. It's when they buy a stock and it goes up, they think they're doing the right thing.
Well, no, it's, you know, I mean, that's true. That's totally right. I mean, I think in the bull market, I mean, it's easy to be long. There are times in markets where the market's down every single year for 5 years, and you have to find a way to make money. Like good companies, stocks drop like 30, 40% a year. Average companies drop 70%, and bad companies drop 90%. I think you were mentioning Amazon before, you know, where Amazon has always been a great company, and still the stock dropped 95%. So I remember very well. Microsoft was $75. I remember where I was sitting, and I was looking at it, and I was like, this does not look like a good buy. This looks like not a great safe haven. And it took a decade for it to come back, even though the craziest thing, and this model's on my GitHub if anybody wants to see it, but like revenue and earnings grew every single time, every year. So like the business and the stock were two totally separate subjects. And Cramer, I have this old email from 2000 that Cramer sent me. I was asking him what he thinks was going to happen in the dot-com bubble. It was literally the throes of the bubble. And he said, some of these are good companies, but bad stocks. And some of these are bad stocks, but bad companies. But they're pretty much all bad stocks at the moment.
The average investor, I feel like, is just buy good companies, And that's better than buying bad companies. But a good company can be a bad investment
totally.
At the wrong price.
Yeah, you have to have some some quantitative ability to say like, yeah, maybe bonds are better right now, maybe cash is better right now, maybe anything is better right now than buying like even like Costco and Walmart are like 40 times earnings. Like I don't want that.
That's crazy. even value is extended. I think one of the things too that you brought up that I wanted to just comment on in terms of risk mitigation, like I think even like Robertson in his last couple of years just evaporated shareholder capital. Like you can have an amazing run for 10 or 12 or 15 years, and one down year where you're down 30% or 50% literally ruins everything.
It's what happened. It happens all the time in hedge funds because of what you could obviously, you would tell me, pretty easy to predict. It's just arrogance and hubris. I have some personal issues with him that, it is what it is. But I mean, it happens to anybody. Tiger, it happened to Clarium. Peter Thiel's one of the best investors ever. But even Thiel, at 10, 15 billion or 20 billion, I forgot how high he got, it sort of gets to your head, I think, no matter who you are. If you have all those zeros right at your disposal, it's just hard not to get a little bit heady, where you start to feel like the master of the universe. And then you make some bet and maybe you're wrong and you don't want to get out, and because you're the best, how could you be wrong? And all of a sudden you're wrong, and maybe you're wrong temporarily, but it doesn't matter. You get cooked. And it seems to happen to virtually every hedge fund. Like there's almost no hedge funds that have, Buffett's amazing in the sense that his returns slowed down, but like his style didn't really change. Just patient, waiting, taking advantage of the things that he did have. Because hedge funds have that issue where your capital drops as your performance drops. So like arguably for Buffett, it's like, no, my capital is kind of, like I said earlier, it's going up no matter what, because my railroad's making money. My insurance company's making money, et cetera, et cetera. So even if I have a 20, 30% drawdown in my investment portfolio, very quickly it just kind of, recovers very quick.
The second comment regarding your quantum. So currently I'm holding some puts on RGTI. Do you think it would be a better strategy to move that to short rather than continuing to hold out some puts a few weeks out after the earnings?
Yeah, everybody asks this question like every day, and I just feel like, there's no real difference that I can add that's like intellectual. Like, what a put is, what shorting stock is. Like they're fundamentally different, and they're fundamentally kind of both bearish bets. And you just have to decide, what the feature of the put is that attracts you and what the feature of the short is that attracts you. They both have trade-offs. To me, I guess like one philosophy is if you can avoid options altogether, you should. There's people that trade options because they're sharks. So like volatility traders who are like, they basically built a machine to milk money out of volatility. Assume that's 99% of us. That's not us. These are really professional, sophisticated guys. They trade options for a living. Then there's us. And us is people that are mostly not even hedging. They're taking the option to make a directional bet. And that directional bet is inherently levered with that option, unless you're doing a spread or something like that. And again, I assume 90% of us are not doing that. So you're buying the call because you want to make a ton of money. You're buying a put because you want to make a ton of money. Cool. But the problem is, again, we're getting back to greed here, because if you buy 5% of your stake in some option, there's a decent chance the option goes out worthless. And so what I like to do is, if I do find myself interested in trading an option, I go like a month later than I thought than I'd like normally want, and I go like 10, 20, maybe even 30 or 40% more in the money than maybe I wanted to, because options are so levered that if you're right, you'll make a fortune. But if you're greedy, you could be 1 month off or 10% off and you lose everything. And I feel like, trading options is kind of like, it's just like really like, there's no need to do this. Like, there's no point in like if I like the stock 𝗍𝗓, and I've been buying it for a while now, and I think it's about to like double or something. And I'm like, oh man, if I buy the 20 calls, or the 25 calls and it doubles, I'm going to make a zillion percent. Cool, true. But I don't know that it's going to double next month or the month after, or quite frankly, at all. It may not, it may go down. And, you know, to be the guy that lost a bunch of money, like Steve said, let's say it did 5%, now I have $95 or cents on the dollar. Now I have to compound all over again. Why? Never lose money is the first thing. And I just threw 5% of my money away on a whim. And I know everyone here has done it. Every single one of you might be doing it right now on some call options because I'm hoping to get that 100x or that 10x. And now I'm down to 95 cents on the dollar. Now I got to, like Sisyphus, I have to roll the boulder up the hill again. Then I get back to 100 cents by doing something smart. Then I throw it away again on doing something stupid. And I think just stop doing the stupid thing, you know, just stop, you know, if you're going to buy a call, like SRPT's 23 right now, okay, buy the 15 calls, buy the 12 calls. Why do you need to buy the 20 calls? The stock's 15% away from that. I mean, if the stock drops to 20, the calls are worthless. You lose 99%. If the stock drops, even if the stock stays flat, you know, you're going to lose money because of the implied vol. You know, you're basically saying, I know the stock's going to be up by next month. Well, you don't. Nobody knows that. And I think, like, the market serves you up what you ask for. You want a whole boatload of risk? Okay, here we go. Just don't order a whole boatload of risk and then say you thought you were ordering, you know, it's like you're ordering a big chocolate cake and you get, you know, a chicken sandwich. You know, you want the risk. The market will give you the risk. It's just a question of, like, you thinking that you're making a sane bet when you're really kind of making an insane bet. And if you do this 20 times, you know, generally speaking, when you're buying options, like, you're going to lose most of the time. So there's no arbitrage. So I feel like, you know, I just try to avoid
options are impossible. You have to get the direction of the move, you have to get the magnitude of the move, and you have to get the duration right. Like getting any one of those three right is already something special. And then to get all three,
bingo,
and then to get it on the right probabilities. And I think that's where people, you know, like the guy who came on earlier, like, they're just misguided. It's like, if somebody went into the casino and turned 1,000 into 100,000, you wouldn't call that person a smart man because clearly they're paying a game where the odds are rigged and not in their favor. And, like, ultimately, all investing is, you know, good investing is making positive EV bets. And the problem is, like, sometimes in the short term, the negative EV bets don't play out, right? And the positive EV bets, the negative EV bets do play out, and the positive EVs don't. Right, so you could be making a sound investment where something's a 60% probability of happening, and you put a ton of money on it, and it loses.
Right.
You're right. Like, so you could look like an idiot in the short term, even though you were right. So, like, but if you make enough positive EV bets over the long term, you're obviously going to do really well. But I think that's what a lot of these guys, you know, like in the short term, they think that they're really smart. But these are also the same guys who said, oh, I think Apple's going to go up because the iPhone 17 is coming out.
Yeah.
You know?
I would caveat, though, there is a case for the leaps, I would say, like the longer duration options. Like, I think it is reasonable to have, like, say, a 12 to 24-month view. And if something is really out of favor and the vols are cheap and you can really, like, express that view in a way that's sized right, I've seen a lot of success with, like, those longer duration. I think the shorter duration are total gambling for the most part, and so I agree on that. But I would caveat that for some people, I think the leaps are interesting to look at depending on what your view is.
I think a lot of professional funds, like the long short guys, they try to avoid options. But in the case of leaps, you know, I do think they're like a capital efficient version of putting your trade on, and I think that can work.
Exactly.
You know,
going back to, like, you could be 30% exposed, right? But if your 30% is like sourcing a lot of leverage, then, you know, notionally it could be the same. Yeah,
so I like that idea, especially if the implied vol isn't jacked. Like, I like sleepy, like, I want the convexity. I want to buy low vol that turns into high vol in my favor. And so, like, I would never buy, like, call options on Palantir because and again, I'm assuming, I could be wrong here, that the vol is jacked. I'm not going to buy put options in Quantum for the same reason. Because the market knows it's trash and the puts are jacked for that reason. But, like, if you find a stock that's, like, about to go from boring to exciting, like, that's when you can do a leap and you're going to get this massive, you know, win. So again, the easier thing to do instead of, like, dodging landmines is just don't do it at all. And I think that's kind of what Buffett said.
Yeah, instead of learning how to dodge landmines, just don't walk into land.
Yeah, exactly. And so, you know, it may tempt a professional to occasionally do it. And like my old Tiger boss, Steve, he I mean, in the $2-3 billion portfolio, I don't think we ever, maybe once or twice, had options. And I think like Buffett has always said, like, just knowing the direction, I love that Steve said that. I don't think he said the word special, but like direction is like hard enough. Like you can master direction. Who cares about timing? Like, I mean, everyone asks, Martin, I know you have confidence in the quantum short, but I think your timing is off. And I'm just sitting there like with my hand on my chin, like, oh yeah? You think the timing's off? When's the timing gonna work then? You know, because you tell me, if you can figure out the timing and the direction, I mean, there's only one man who can do that. That's the man upstairs. I don't think it's gonna be you and me.
Facts.
Writers.
The other thing too with that Martin highlighted with calling implied vol is like, if you know your house is going to burn down or there's going to be a hurricane, insurance can be really cheap. But if you go try to buy insurance while there's a hurricane going on, it'll be jacked through the roof.
Yeah, that's a great analogy for volatility.
You really have to get it before it's a thing. If everybody knows, man, this thing is insanely volatile, it's going to be priced appropriately. There's not going to be an arbitrage opportunity here.